100 billion mark note. Is hyperinflation waiting for us? Inflation is not a game. Protect your assets. Hi, and welcome to our video. Have you ever heard of the 100 trillion mark note? And does such a fate await us in the coming months? Inflation is not a game. Protect your assets. We show you some tips, explain the cause of inflation, and what you can do to protect your assets. The 100 trillion mark banknote was a new bill issued by the German government during the hyperinflation of the Weimar Republic in the early 1920s. The bill was issued on 15th November 1923 and was the highest denomination ever issued for the mark. While in 1919, the exchange rate was $1 to 7.95 marks, inflation in Germany increased so rapidly that in November 1923, $1 was equivalent to 4.2 trillion marks. Smaller bills, less than 10 billion marks, were only burned in the fireplace and thus used for heating. Shopping was no longer possible for this small value. The banknote featured a portrait of the German poet and philosopher Johann Wolfgang von Goethe on the front and a vignette of a seated female figure representing Germania on the reverse. The banknote was removed from circulation soon after it was issued and is now a collector's item. We would appreciate it if you subscribe to our channel and give this video a thumbs up. Thank you! How did hyperinflation happen in 1923? The 1923 hyperinflation in Germany was a direct consequence of the beginnings of the Weimar Republic. Germany's severe economic situation after World War I and the Versailles Treaties led to an increase in national debt and a devaluation of the German currency. The Rentenmark, which was introduced as the new currency, had very little value, so the money in circulation soon lost its value. This eventually led to hyperinflation, where inflation became so high that money lost its value almost completely. What is inflation, and how is it different from hyperinflation? Inflation is an increase in the price of goods and services. It is caused by a reduction in the buying power of money and can be a sign of a weak economy. When inflation is too high, economic problems can result because people have to spend more money to get the same amount of goods and services. Hyperinflation is an extremely high level of inflation, where there is a 50% increase in inflation each month compared to the previous month. This results in a rapid loss of the value of the currency's purchasing power, leading to an increase in the price of goods and services. Hyperinflation is a very serious problem, as it can lead to a drastic devaluation of the currency and a loss of confidence in the national currency. At the end of 1923, the inflation rate was several thousand% per month. To buy a bread, people went to the bakery with wheelbarrows full of money. The hyperinflation in Germany was solved by a currency reform, the Reichsmark. When is inflation problematic? Inflation is considered problematic when it rises too fast and reaches too high levels. High rates of inflation not only reduce consumers' purchasing power, but also affect the economy by reducing savings, increasing costs for businesses, and making investments more difficult. For some people, therefore, inflation of 7 to 10% is already very problematic financially, as they can afford significantly fewer goods and services, and financing their living becomes more expensive. Is hyperinflation coming again? No. Hyperinflation is not to be expected. Most economies today are structured in a way that hyperinflation is very unlikely. How expensive will the future be? It is difficult to give a clear answer to this question because the cost of the future depends on many factors, including the development of new technologies, the availability of resources, the global economy, and other factors. However, we can say that the cost of the future will increase in many areas. As new technologies are developed, the price of technologies will increase. and the cost of resources and other factors may also increase. This means that the cost of the future will generally be higher than today. How can you protect yourself from inflation? This is not investment advice. Look for assets that suit you and get detailed information about them. On the one hand, you can rethink your investments. On the other hand, you can take advantage of saving opportunities. In terms of investments, you can consider the following. 1. Invest in real assets. When inflation threatens, it is a good idea to invest in physical assets, such as real estate, precious metals, artwork, etc. These assets usually have low volatility and can help hold value during periodic inflation. 2. Invest in stocks. Invest in companies whose profits increase with inflation. Such companies can benefit from rising prices when other costs rise. However, you should be careful because stock markets can be volatile. 3. Invest in bonds. Invest in bonds that have a real interest payment schedule, i.e., an interest payment schedule that is linked to inflation. 4. Save your money. Save your money in a local or international savings account to be protected from inflation. When inflation increases, the value of your money remains the same. 5. Invest in different currencies. Buy currencies that are printed in another country. This can be a good protection against inflation in your own country. 6. Save in an energy savings plan. An energy savings plan is an account that pays you interest that does not increase with inflation. 7. Invest in commodities. Invest in commodities such as oil, gas, copper, or corn that are insensitive to inflation. Useful responses to inflation can be different depending on the situation. The following savings options may be useful for: 1. Reduce your spending. If you see the signs of increasing inflation, you can try to reduce your spending to maintain your purchasing power. 2. Earn more money. When prices are rising, it can be helpful to increase your income to support yourself. 3. Increase your liquidity. Increase your liquidity by putting money in a savings account or a demand deposit account that offers a higher interest rate than a regular savings account. 4. Increase your insurance-based retirement savings. Increase your insurance-based retirement savings by investing in an annuity or life insurance policy to protect your retirement. 5. Look for ways to save money. Compare prices, shop at sales, and take advantage of coupons and discounts. 6. Avoid consumer goods whose prices are most affected by inflation, such as food and energy. 7. Keep up to date with the economic situation in your region and the world so that you are better prepared when inflation rises. How can you stop inflation and strengthen the economy? Inflation can be stopped by central banks adjusting monetary policy to stop inflation. This can be done by increasing the prime rate or selling bonds. This affects the relationship between supply and demand so that prices fall. Furthermore, fiscal policy can be adjusted. The government can adjust fiscal policy to stop inflation. This can be achieved by increasing income taxes, reducing government spending, or reducing public subsidies. These measures lead to a reduction in the money supply, which in turn leads to a decrease in inflation. The government can maintain monetary stability to stop inflation. This can be achieved by introducing a fixed exchange rate or a currency basket. This creates a stable price environment so that inflation can be limited. On the other hand, the economy should be promoted and strengthened. This can be achieved by facilitating investors, e.g., by increasing investment allowances, reducing taxes on investments, or increasing credit lines. These measures lead to more investment, which leads to economic growth. The government can encourage innovation to strengthen the economy. This can be achieved by promoting research and development, giving tax breaks to innovative companies, or encouraging technology transfer. These measures result in new products and services that lead to more economic growth. The government can promote trade to strengthen the economy. This can be achieved by reducing trade barriers, facilitating exporters, or encouraging investment in export-oriented companies. These measures lead to more trade and more growth. So, in summary, we are not expecting a new 100 trillion bill or hyperinflation. However, there will always be inflation and devaluation of money. How high this is depends on many factors and can be influenced on the one hand by the state, and on the other hand by your behavior. What is worrying you at the moment? Are you already in financial trouble due to the current inflation? Leave us a comment and subscribe to our channel so you don't miss a new video.